Okay, so you're welcome to this another section. We are now into Unit 3. So far, we have done a good job trying to look at the foundation of this course, really. So far, I think we now know how to define a bank. Okay. I think at this point now we are also familiar with basically how the licensing is done, right, in Zambia. So how is the licensing done? By now we are also familiar with basically the raising, okay, of deposits by commercial banks, right? So the different types of deposits, we discussed that. Other interesting concepts were around money creation, that banks can create money, okay. And other things such as just basically, the balance sheet management, right? The balance sheet management, and the alcohol committee that we talked about. So today we want to get into the core of banking, which is basically lending. Okay. So this is really the core business of the bank. Remember that this is where we are really getting majority of our revenue, our profits, and so on and so forth. So we have to look at the issue of lending. Okay. So basically, as bankers, we should be able to of course, we'll look at lending and the types of loans, but we should be able to look at the lending process, right? How do we apply the 5 C's? Okay, as application of the 5 C's when someone is applying for a loan, right? Okay. The pricing also of these loans, very important. Okay. um Remember that lending introduces the biggest risk to the bank, which is credit risk. So credit risk management has to be looked at here, at least briefly, but I know that there are going to be subsequent courses that will do, such as risk management, that will be able to capture this risk and its management in full. We will also learn about the monitoring of these loans. Remember that not everybody might pay back, so we need to look at calculations around the possibility of paying back. Okay, and then I think finally we'll look at now, what does the regulation say around lending. So it should be an exciting topic, this one. Quickly, so what we'll do in the first part of this presentation, we'll define what lending is. Okay. And then we'll obviously move to how banks determine who to lend to and what, okay, they lend for, as well as under what conditions. Okay. So those are the things that we'll look at. So using the 5 C's, the type of loans, what about the secured and unsecured kind of lending? We should be able to have an idea there. Okay, so we can make some progress. So now we try to define what lending is. So lending really, a bank loan is a contractual advance of funds, okay, to a borrower. Okay, and what it is it doing? It is specifying the amount, it is specifying the interest rate, it is specifying also the repayment schedule, the security and the conditions. Now, in exchange for bearing the risk, okay, of non-repayment, the bank, okay, earns interest, and we are saying that this is a primary source, of income. So this is very important. So what are you finding in the definition? You are looking at the risk and return trade-off. That the higher the perceived risk, the higher the interest rate charge. This is a very important principle that you need to appreciate, even in the subsequent courses that you come across. Just know that the higher the risk, the higher the return, or in this case, the higher the perceived risk, the higher the interest rate that will be charged. Okay. What else are we saying? We are saying that obviously this is a primary income source, right, for banks. So the idea is that we actually have to find the difference between the interest that we earn on the loans and then the interest that is paid to the depositors. We have already talked about the depositors in the previous unit. So now we are just going on the other side of the balance sheet where we are now talking about the loans. So the difference between the two really gives us, an idea of the what's this of the profits that we are making. So imagine that, for example, you are earning maybe 8%, 18% on the loan, okay, and then you are you are giving 8% on the deposits. So it simply means that your profit margin is 10%. Now 10%, maybe multiply by maybe the deposits that you have, maybe say 1 billion, okay, and so 10% of 1 billion becomes your profit. So you can imagine, so banks make a lot of money, but obviously our biggest challenge is the possibility of the default, of the borrower not paying back, or the possibility that the borrower might default. And this is what we call the credit risk. It is the #1 cause of bank failures globally. Okay, so please don't forget that. Let us appreciate these concepts. Really, the banks are an economic engine. It is behind a lot of these things that we see. Most of the funds that are going to agriculture, mining, construction, all these economic activities, you find that there's a bank involved in one way or the other, especially through its credit extension, process. So really, let us appreciate this arm of the bank, which is the lending arm. Okay. So I think next, let us see if we can go to the 5 C's. Okay. Okay. So what are we saying? So we are saying that the 5 C's are critical because they're doing a number of things before we can actually extend credit. So the first C that we try to look at is character, right? So character, we are trying to ask a question like, will this person repay, right? Will they repay if they are able to repay, isn't it? Okay. So if they're able to repay, will they actually pay? So this is an integrity kind of question. Okay, it's a question where you are trying to see someone's track record, isn't it? And so for us to look at this, you find that we look at the borrower's credit history, the banking relationship, the business reputation, as well as referees, just to understand the character. Okay. For credit history, at least in Zambia, we are able to consult the ZCRB, which is the credit Zambia Credit Rating Bureau. Okay, the ZCRB, right? ZCRB. Okay, the Zambia Credit Rating Bureau. Anyway, so that is that. So the other one is, yeah, so basically that is that. So the other one is capacity. Okay, so capacity is talking about now. So previously we said, will they repay? But now we are saying, can they repay? What is the actual capacity of them, paying back? Okay, and usually for us to really, be convinced here, and it is quite quantitative, this measure, we have to look at what we call the debt service coverage ratio, right? The debt, service Okay, coverage ratio. Okay, so the debt service coverage ratio, which is the DSCR, is what we are going to use, to check um, someone's, ability to pay back. Will they be able to pay back? The capacity to pay back. Okay, it is quite decisive. So we'll get back to that. The other one, the other C, is the issue of capital. So now the issue of capital is answering the question, what is their stake? Okay, what is their stake? Okay, so for example, if maybe someone maybe contributes, look at an example where someone contributes 30% um, to maybe purchase a property, isn't it? And then they borrow the rest of the 70%. Yeah, at least this person has got like a real skin in the game, isn't it? Because it appears to me that they will fight harder so that they don't default, as opposed to a situation where someone borrows the entire 100%. Now, if someone borrows the entire 100%, you can be assured that they will not feel bad, or they have got nothing to lose if a project basically fails. So that is the challenge. So capital, has to be looked at as well. Very important. Then we have collateral. So collateral is a fallback position. The question there is, what secures this loan? So that's what collateral is answering. What is actually securing this loan? Okay, a fallback position. Okay, or a safety net. Right. So in other words, if a borrower cannot maybe like repay from their income, then the bank can basically just take over the whatever asset or whatever collateral and sell, right? And sell. So that is that. But it is very important to know that collateral it can never be, maybe I need to write this. Collateral can never be the primary. Okay, so collateral can never be the primary reason to approve a loan. Can never be the primary reason, okay, to approve, a loan. No, it can never be, right? So those are the issues there. Then after that, we are looking at issues to do with conditions. Conditions is very important, because with conditions, we are now answering the question, is the context right? Okay, so in conditions, we are saying we are looking at everything external, right? Here we are looking at everything external. Okay, we are looking at everything external. Look, we want to, in here, we want to establish, for example, what is the purpose of the loan, right? Maybe what industry, right, does the borrower belong to? Okay, and then even issues to do with like how is the economic outlook in Zambia right now? Because to tell you the truth, sometimes you find that a business might be profitable, but it is in a declining kind of industry. So because of that, they may be, that borrower can actually be a poor or bad credit. Okay, even if their financials look promising and their financials look acceptable, but because of the industry. So those are the things. So economic outlook, industry health, purpose, as well as the tenure of the loan. Now, what are we saying in conclusion here? We are saying that all the 5 C's must be evaluated. Okay, a weakness in any of the C's may justify, okay, the declining of the loan. Very, very critical. But otherwise, if you were to ask me, I feel like issue of capacity is the most critical. We need to be satisfied that someone can actually pay back, because if we just want to be satisfied by just using collateral, well, actually, if you read or you research around the 2008 global mortgage crisis, basically that was the reason. Okay, the reliance on collateral as opposed to capacity, which is basically the ability to repay, okay, from your income. That is very critical. That is very critical. Okay, so let us now go to the types of bank loans really quickly. Okay, so the different types of loan products, typically you would find that you have got what we call overdrafts. So overdrafts are a good facility for businesses, especially because they are so flexible. However, the challenge is that despite their flexibility, they are repayable on demand. That's the risk that is there. Okay, meaning that the bank can basically demand a full repayment at any time, right? So that is where the challenge might be. But otherwise, businesses are fond of this facility. The only challenge is if you get used to this facility as a business, you might be in a tricky situation when the bank actually decides that they withdraw that kind of facility. So that is a challenge, but it's a good facility. Okay, the overdraft. So read about that. We do also have types of loans such as the term loans. Term loans, yeah, this is like the workhorse of business lending. Okay, because here what you find typically is fixed repayment schedules. Okay, you find that you know you're looking at situations where um, purpose is defined. Okay, purpose is defined, and also usually these ones are secured. Okay, so these ones are usually secured. So read about that. The other one is obviously mortgages. So a very interesting product, this one. um, yeah, but it is long term, isn't it? So in terms of nature, it is long term, and then the property is the security, right? Yeah, so you find that I think this one, the appreciation is that, especially when it comes to like issues to do with home ownership or commercial property ownership, this is what allows for that. Okay, this is really what allows for that, and it's a very good product. Others include trade finance. Now, trade finance is very important, especially when it comes to international business. Like our country, Zambia, we are obviously import dependent, isn't it? So import heavy, economy. So you find that typical products here would be letters of credit, for example. Okay, and like we said, letters of credit are guaranteeing, okay, a supplier. For example, in China, we guarantee that, okay, um, the other party will make good on the payment, isn't it? Okay. So basically, you find that the bank is able to guarantee both sides of it mediates the transaction and guarantees payments on both sides. So those are the things I think. Try and see if you can read through these facilities. A personal loan, yeah, for personal loans, these ones are. Yeah, so for personal loans, really, mostly these the consumer credit. Okay, they are usually unsecured, and in most cases you find that they are simply payroll deductions that we do, and then the interest rate is quite high. So what are we taking away from this? What we are taking away from this is that the concept here is that when a loan is secured, you find that interest rates are usually low. Okay, sorry, so the lower rates apply. Meanwhile, if it is unsecured, it will actually attract higher rates. And then also the issues of, so meaning that the issue of collateral reduces the bank's credit risk. Okay, so that is why a, lower rates, okay, or higher rates apply respectively. Okay, so that is basically that. Okay, other things that you may quickly need to look at is the difference between secured and unsecured lending. Okay, so so when we look at, for example, collateral, and remember, like when it comes to, just to emphasize this point, when it comes to whether unsecured or secured, you need to know that this is actually what is driving interest rate pricing. Okay, so how much are we going to give you credit at? Okay, as well as the approval decision. So the pricing, okay, maybe I just need to write this. So the pricing and approval decisions, okay, and approval decisions will be based on whether secured or unsecured. So like we said before, you find that secured loans are cheaper for borrowers, right? Because the bank can recover its money by selling that asset, right, if payment fails. Okay, I think we already talked about that. Okay. All right. So when we talk about issues of collateral, if a facility is secured, then it means that it does have collateral, and this collateral can be in form of property, can be in form of equipment, or even shares, right? But if it is unsecured, then we are just looking at the credit worthiness only. We are not looking at collateral. When it comes to interest rates, obviously, if a facility is secured, then it will have a lower rate, like we have already talked about, because of the reduced credit risk, isn't it? Meanwhile, in this other case, you find that it is higher because the bank is basically bearing the full risk. Okay. In terms of loan size, yes, you would expect that if it is secured, then the loan size will obviously be larger, right? Usually up to the value of the collateral. But for unsecured, they are usually small, and they are tied to the income. So depending on your income levels, if you only get paid maybe say 10,000 a month, then it will dictate the amount that we can give you. Okay, and it will be lower than someone who is maybe getting a 50,000 per month, right? So what about the risk to the borrower? Yes, when it is secured, there is a risk to the borrower because the property can be seized, isn't it? So a borrower loses out. Meanwhile, on this other side, the only thing that is a risk is the fact that your credit score is damaged. Okay, and obviously there are also legal actions that might follow. Okay, examples quickly. It's a mortgage, okay, a mortgage facility, okay, asset finance, or even trade finance. We're just from talking about this. And then examples of unsecured, it is usually issues to do with a salary loan, okay, a credit card, or even an overdraft. But what are we concluding on this slide? We are saying that the lower the security quality, the higher the rate. So it's also about the quality of the security, not just the presence of the security, but also the quality of the security. So if the quality is low, then you expect that the rate will be higher. Okay, and if the and obviously the smaller the amount of loan that will be able to give you. These are principles that we always have to remember. Okay, please let us not forget these very, very, very important concepts. Okay. Okay, so the lending process. Um, I think here we will look at like 8 steps usually that that banks will take as they are trying to to basically give out loans, right? So everything from the first inquiry to when the funds are actually dispersed. Okay, so that is very important. So we'll look at the different steps, but they like these banks really they may not um also most of the okay these banks have got some version or at least resemblance of what we are going to talk about, right? It might not be exact, but that is basically the issue, so that they protect themselves, isn't it? So that the bank protects itself, it protects the borrower, but also protects the whole regulatory framework. So after we discuss this, I think we'll get into some quantitative analysis where we will have to look at checking if a borrower can repay back. Remember we talked about this. Okay, and also have we done the pricing correctly? So those are some of the things that we'll do in this section. So quickly, when it comes to the loan origination process, that's basically how it looks like. um, the first step, obviously, this is yeah, in fact the first two steps, really what is happening here is that this is like the intake, stages. Oh, sorry. This is 1 and 2. My apologies. So 1 and 2. These are definitely the intake stages. Why are we saying this? We are saying at this point now we are looking at relationship managers, isn't it? That's where relationship managers, basically come in. Okay, so in those stages, we meet the borrower. Okay, and then information is gathered, and then we basically create what we call a credit file, isn't it? Okay, so a credit file is assembled, and then this is what we'll forward to the back office. So we'll forward to this part now. So we go to the credit analysts. So in most cases, anyway, in all the cases actually, typically, you'll find that credit analysts, who have never actually even met the borrower. Okay, and so this means that there is some kind of objectivity. Okay, there is a bit of a conflict here. On one side, the relationship manager is trying as much as possible to win business, isn't it? Okay, yeah, because remember we are trying to what's this to lend as much as we can so that we make money. So they're trying to win business. That is their job description. But meanwhile, the credit analysts also have got a job description of making sure that um, we give credit appropriately, isn't it? So around the credit assessment, that's where we utilize the 5 C's that we talked about. And then we also have to look at financial spreading. And then we also do issues to do with how about the cash flow review as well. So how is that going? And then after that, then there is usually the approval stage. Okay, so this is the credit approval stage, stage 4. Okay, so here in most cases, obviously this cannot be done by one person alone. So there are usually credit committees that would actually approve these loans. Okay, yeah. So so you find that these credit committees, again, typically the composition would depend on the size of the loan. So maybe if it's just maybe 100,000 kwacha salary loan, yeah, probably the branch manager can approve that one. But if, for example, we are looking at 5 million, right, a corporate loan, then obviously the board credit committee would have to sit so that they look into that. Okay, so that is basically that. Really quickly, um, we just need to make sure here that um, yeah. So the other thing is the issue of documentation and disbursement, isn't it? So here, once we are satisfied, then we are saying that a loan agreement can be signed and then security is registered. This is very important. Another course that we'll do in this program is what we call residential lending and property law. So you find that if the collateral that you have obtained, maybe it is a house, you have not registered it, okay, at the local authority, it might be that when default happens, you may not have an upper claim, right? Than others who may have already registered their interest. So that is the challenge. So always make sure that the security is registered. Okay, and then when it comes to disbursement, we are only saying that these funds can only be dispersed when, okay, conditions have been met. Okay, so until all the conditions precedent, okay, are met, and the security is properly registered, then we can release the funds. Now another critical part of this process is the monitoring. So you find that the monitoring will begin on the day that the loan is actually drawn, and then it will be ongoing. Okay, it will be ongoing, until the last payment is made. Until the last payment is made, then we stop the monitoring, obviously. But the idea is, as much as possible, we want to monitor so that we can flag any red flags, isn't it? So that we can early warning flags anyway can be tracked. So that is very, 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 very important. Um, just to emphasize here, we are saying that the approval stage, which is the fourth stage, is a decision point. Okay. Meanwhile, the monitoring stage, which is stage 8, is where most credit losses are either prevented or discovered. So that is our food to digest. Okay, that is our food to digest. Especially that when you look at approval is mostly you're approving based on projected information, isn't it? But now for monitoring, you are actually now looking at the actual performance. Okay, the actual performance. So yeah, so that's that. So a borrower can look very excellent at approval, but they might deteriorate 6 months later. So basically, monitoring very key, ladies and gentlemen, because that is how we are able to catch um, losses before they actually become losses. Okay, so that is basically that. So we continue quickly. Let us look at one of the most critical, calculations when it comes to commercial lending. Um, because remember that this debt service coverage ratio is telling us, or at least, yeah, so it is telling us to say, like, for every quarter of the loan repayment due, how many quarter of income does the borrower generate, isn't it? Okay, so in other words, the formula is for your debt coverage ratio your formula is the net, okay, the net operating income divided by the total, the total annual debt service. Okay, this is a very powerful ratio. So what can we do here? Let's look at an example. For instance, if I said that the net, let's assume that the net coverage, let us assume that the net operating income, for example, so the net operating income of this customer is, say, 180, right? 180,000. Okay, and then meanwhile they have an annual debt service of, maybe, say, so they have got an annual debt service of let's assume maybe 150. Okay, so if we are to find the GSCR, then it means that all we need to do is to say that our 150, okay, sorry, our 180, okay, should be divided by 150, as simple as that. Okay, and then you will find that what you have in this case would be like 1.2, right? So 1.2, then we go to your criteria. Where do we have 1.2? You find that we are having 1.2 here in the borderline. Okay, here in the borderline. So meaning that there we are saying, okay, fine, the borrower can pay, right? They can pay, but the problem is that it is only a 20% margin, isn't it? Okay, they can pay, but only, a 20% margin. So you find that in most cases, actually, and this is the criteria, this is what most banks expect, that you have this coverage ratio at least of 1.25. This is acceptable. This is borderline. So at borderline, in most cases, you would need extra security, or at least extra guarantee, okay, before you can actually approve. Okay, before you can actually approve. So that is a golden rule, really. It is very important. What we are saying here, the golden rule, sorry, here is that never approve a loan based on collateral alone, right? Never approve a loan based on collateral alone, because the idea is that, you see, if for example, the cash flows do not support the loan, then it means that the bank obviously would have to sell the collateral. But the process of selling collateral, can be a bit of a challenge, because, you see, first of all, it is quite slow, right? So you need, it is slow. Meanwhile, you need your money. It is also expensive, right? So because sometimes you may need to do consultation, marketing, whatever. So that becomes a problem. And then sometimes it may be uncertain. Are we going to sell this or not? Very, 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 very serious issues. And then also the issue of damage to the reputation of the bank. So that is why collateral is a last resort. Let us look at cash flows. Are the people able to pay back? And what is helping us look at that is the debt service coverage ratio. So always remember that. Always, always, always remember that. Okay. Okay. So now the next question is, how do banks price a loan, isn't it? How do banks price a loan? So one of the ways is basically your risk-based pricing. So for your risk-based pricing, what we are saying is that it is the cost of funds. So the cost of funds, basically, how much is the bank paying to raise the money it lends out, isn't it? I can remember that this primary source is the depositor. So how much are we giving depositors, right? The primary source is depositors. But the depositors are also mostly linked to the monetary policy rate. And as of first quarter in Zambia, remember that our monetary policy rate is around 13.5%. So around this much, you find that this is what we try to give, the depositors. Okay, obviously argued here, but yeah. So the next item, or the next variable in the equation, is the credit risk premium. Okay, so the credit risk premium, this is where now, individual borrowers are treated differently, isn't it? So here there's some kind of discrimination, discrimination going on. Yeah. Okay. So that is the credit risk premium, because usually, you would find that if you are dealing, for example, with a company which has been in existence for a while. Imagine you are dealing with Zambia Sugar. Okay, now Zambia Sugar obviously has got a track record. Okay, so you find that the premium on those maybe may just be 1%. But on the flip side, if maybe you're now dealing with an SME, with limited history, maybe accounts not audited, then the risk premium, we might have to treat them at 8%, for example, right? So that is that. But also we add what we call the operating cost margin, and then we also fuse in our profit margin as well. So typically that is how it works. So if you look at this example here, a situation where you've got a credit risk margin, okay, and then the operating cost margin, and then you also have the profit margin. So what you are doing there is okay, so what are we saying here? So the cost of funds, what figure are we using? So the cost of funds, okay, 11%. Okay, risk premium, 4%. Okay, so here we're just assuming that the cost of funds is basically 11%. So, and then imagine that we are dealing with a customer who is not very risky, so we decide to give them a 4% in terms of the risk premium. And then also we pick, in terms of our operating cost margin, from that range we pick the maximum we get. Sorry, we pick 1.5. Okay, it doesn't matter, 1.5, and then the profit margin we pick on 2, right? So in that case, if that is what we chose, then our lending rate ultimately will be 18.5%. So in short, this is just the risk-based pricing. What you need to know is that this one is reflecting, so the risk-based pricing reflects actual cost. Okay, so it will reflect actual cost and risk, isn't it? Okay, and risk, okay, of a specific loan. Okay, so not a situation where it is like a one size fits all. No, we are looking at something specific. So it does have an advantage to the borrower, because the advantage is that a borrower can actually bargain. Okay, they can actually bargain. Okay, they can bargain or negotiate, isn't it? So they can bargain or negotiate. That is, they will need to prove that they are a lower risk. So how do they prove that they are a lower risk? then they have to show that they've got security, they have to show that they've got better financials. Okay, yeah, basically a longer relationship. So if they can be able to show that, then we can negotiate, they can negotiate for a lower premium, you know, and pay less interest. So that is basically how these things work. Yeah, so next is for us to look at credit risk management. Now, credit risk management really, yeah, this is really what keeps a lot of managers or CEOs awake at night. It can be a nightmare. Why? Is because obviously our biggest risk is credit, isn't it? Credit risk. So in this section, we just want to see if we can, you know, quantify. We can quantify, you know, credit risk. Is it possible that we can also classify this credit risk? And then also, how do we manage this credit risk? So quantification is what we are going to next, where we want to look at what we call the expected what's this, the expected credit loss, isn't it? Okay, so the expected credit loss. So that is what we'll dive into next. So, key concepts or key variables that that compose the ECL, which is expected credit loss, is the probability of default. Okay, so the probability of default is basically the likelihood that the borrower would default within 1 year, and it is usually expressed as a what? As a percentage. Okay, yeah, so in other words, what we are just saying here is that what are the chances that this borrower would default, isn't it? So you find that for very safe borrowers, maybe the probability is just 0.5%, whilst others may go up to maybe 15%, you know, something like that. But anyway, another critical variable is loss given default. Okay, so here on loss given default, we are now answering the question, such as if they do default, right? So if this borrower actually defaults, what is the percentage of the outstanding balance are we losing? Okay, so what is the percentage of the outstanding balance the bank expects to lose if, you know, default actually does what, actually does happen? Okay, so that is basically that. So you find that yeah, maybe there was collateral to this asset. Okay, and then you know, you find that we can recover some of our loss, isn't it? So minus the collateral, that's when we get our loan given default. So it is also expressed in most cases as a percentage, right? And then the other critical variable is the exposure at default. Okay, so the exposure at default is simply, you know, what the borrower actually owes us at the moment of default, right? So how much of the principal and accrued interest, you know, is there at the time of default? Okay, that is basically our exposure to default. Okay, at default, sorry, at default. So that is our exposure. So if we have an example where, you know, and this is a very simple example, but practice different other examples in this handout so that you see how we prepare the exam questions. But for a simple one like this one, where our probability of default is 5%, our loss given default is 40%, and then assume that our exposure at default is 2 million, then we can just place into the figures into the formula, and you'll be able to find the answer to be 40,000. Okay, so in other words, this is actually the required provision. Okay, in other words, we are saying that that is basically what the bank should provide. Okay, as a charge in the income statement. Okay, even if the borrower hasn't missed any payment yet, but that is what you need to estimate as your loss. Okay, so it is forward thinking. It is good practice for the bank. Okay, that they are setting aside their provision, because yeah, like I've mentioned, it is forward thinking, unlike it being like a backward kind of reaction after an actual default. Then that's when you do that. So that becomes a so really the bank must provide 40,000 against the loan. Okay, reducing the reported profit by protecting capital against future loss. So it is a charge against the profit in the income statement. Okay, all right. Okay, quickly, the other part is just the issue of classification. So basically, what we are just saying is that actually the Bank of Zambia, in our case in Zambia here, it actually requires that all commercial banks, have to actually classify every loan in their portfolio. And they need to classify in any of these 5 classifications here that I've listed. So you find that if we classify a loan as a pass or standard, then it is basically, yeah, we don't have a lot of concerns here, but still notice that the Bank of Zambia is still requiring a 1%, kind of like general provision, isn't it? Okay, against that. So it is performing well, repayments are current. Yeah, no concerns. But there is another category or another classification of special mention here. If the days past due now have passed 30%, this could be a sign of early stress. Okay, and here we actually push our provision to like 5%. Okay, so usually in this classification, you find that the credit officers now would have to see if they can engage the borrower and just look at what solutions can be put up so that we just prevent some kind of like further deterioration, isn't it? Okay, but from here we might uh, classify it as substandard. Things begin to get worse, especially if it is past 90 days. Okay, to 179 days. So here now, definitely weaknesses here. Okay, and we go to a provision of 25%. Really, in this now we are just, it is reflecting that there is basically a high probability, or there is a probability of a significant loss, isn't it? Okay, from there we can go to doubtful. Okay, doubtful, now this is where we are now beyond 180 days to 359 days past due. So now here, definitely our full recovery is highly unlikely, especially if the bank doesn't aggressively realize the collateral. Then it means that our full recovery is questioned, that is highly unlikely, and the provision here increases to 50%. Okay, and then finally, obviously, there is the loss. So here, in terms of the loss, the provision obviously is 100%. This is when the loss is past. I mean, when the days past due are now above 360 days and 360 days. So yeah, so basically the bank in this case, expects to recover nothing or maybe nothing at all. So they will have to just write it off. So in this case, we usually have to just write off um, this loan from our books, isn't it? But of course, we will continue pursuing the borrower legally. So the story doesn't end here. We will definitely continue pursuing this borrower legally. Okay. Otherwise, for accounting purposes, um, you need to distinguish that a provision is an accounting concept, isn't it? Which is an allowance for expected loss. So you find that the loan stays in the book, but when you write it off, then it simply means that we have permanently removed it from our balance sheet. But meanwhile, legally, we are trying to see if we can get it. So if we manage to get something from our legal processes, then that will be considered as pure profit, really. Okay. Yeah, so I think the next thing that we need to do as we are almost winding up now is we'll need to look at credit risk management. Okay. Um, Now, obviously, once we assess a loan, or in other words, when we assess the credit risk, um, we just don't go ahead and take up these risks. Obviously, there are things we can do to try and mitigate credit risk. So these are typical exam questions. Some of the things that we may ask for is how do we use collateral and security, isn't it? Okay, so the catch here is to know what is good collateral and what is not. So you find that in that example there, we are showing that the first grade collateral is actually cash, right? So cash is good, but also government bonds can also be good. Okay, so that is that. And then the second obviously is freehold property. Yeah, that can also be good as well for us. Okay, yeah. So other than that, we can mitigate some of these risks by looking at loan covenants. Okay. Yeah, so let us read on that. Other than that, we can ask for guarantees from third parties that they can repay in the event that the borrower defaults. We can do that. Um, we can also look at issues of credit insurance. This is very common. So you find that the bank actually pays premiums to an insurer. You get the point, right? So someone borrows an amount, say 100,000 kwacha, and then the bank on that loan they start paying premium to an insurance company, and you find that usually these costs are shown in the in the structure of the loan that you get. So then it means that the insurer would compensate the bank if the borrower defaults, isn't it? And so this is very common, especially for trade finance and export credit. So the other things, a portfolio diversification, very important, that you can spread your lending across sectors. Okay, and this helps us to prevent what we call concentration risk. Okay, so we are saying do not, borrow above 25% of your regulatory capital. So you can't borrow above 25% of your regulatory capital to one, to one industry or one customer. That becomes a very important. That becomes a very significant source of credit risk. So what you want to do is to spread it around. And so in most cases, then you might need to, because the question is, okay, what if someone Okay, for example, let's see if we can do an example. What if, for instance, maybe you have got a mining company and it wants to borrow 500 million kwacha from you. Okay, they want to borrow 5 million kwacha from you as a bank, but the regulatory capital, for instance, is 800 million. So what we are saying is that you can only loan out up to 25% of this 800. So 25% of this 800 is how much? It's 200 million, isn't it? Okay, so it is 200 million. So in other words, we are saying that this 200 million you can lend out, but the remainder of the 300 you may need to get into an arrangement of syndication. So syndication is a situation where um, you bring other banks together. So loan syndication is a situation where you bring other banks on board, okay, so that they can take up portions of that loan amount. Okay, so in other words, it's like you're actually sharing the risk, isn't it? Okay, you're sharing the risk. So these are the things that can be done to address or at least mitigate credit risk. So very important, always. Okay, so let us quickly look at loan monitoring. Obviously, loan monitoring is very critical as well here, because really, you can do a lot. You can do a very good job when it comes to the origination of the loans, something that we have been looking at previously. So you look at the 5 C's and all those things, you do a good job, but um you know some of these loans will still go bad, unfortunately. Someone, a mentor of mine, actually said that the difference between a well-managed bank and a poorly managed one, is about how quickly they detect problems and how efficiently they respond to those problems. So in other words, we are talking about the loan monitoring situation. Okay, we need to be able to see the early warning indicators as a bank. So we need to have such kind of systems where we can be able to look at those things. So early warning indicators, which we just shorten as our EWIs, we can look at them. So we can classify them into three. We can look at the financial EWIs, and we can just see, wait, it looks like last year this company reported 5 million profit, but this year they have reported 3.5 million profit. So then that is already beginning to show some kind of concern, isn't it? Okay, some kind of concern. And also sometimes in the financial reports you pay attention to the auditors comments, especially if there's a comment such as a going concern qualification. So already that becomes some kind of like a serious warning sign, right? Okay, so even financial ratios can be done so that you're able to see how this borrower is faring. Other than that, you can look at the behavioral early warning indicators, for example, irregular or partial repayment patterns. Okay, so a situation where maybe a direct debit, for example, has bounced twice in the last quarter, for example, then obviously there's something wrong, isn't it? Okay, or a situation where you look at maybe if the frequency of the request for overdraft limits. Again, that is a problem, because if a customer is requesting for an overdraft every month, and the limit is actually increasing, then the problem is not temporal, it is actually a structural problem, isn't it? There are bigger problems there. Okay, so those are are the issues. But other than that, you can also look at the external early warning indicators, such as industry or sector downturn. Okay. Yeah. So key customers or borrowers becomes insolvent, isn't it? Or yeah. Okay. And then issues of you can always check for commodity prices, and so on and so forth. So, and then other things obviously that people miss is the management early warning signs, right? So you find that maybe, wait a minute, directors are resigning, there are disputes going on, litigation. These are warning signs. So again here, as credit officers, okay, it is very important that we need to do a lot of reading in the morning. Okay, I mean, sorry, we need to just be people who read. So read financial news so that you see what the external environment is saying, but also look at the portfolio reports. Okay, it is very important. Okay, so that at least you are able to connect external events to specific borrowers. Okay, before a borrower even realizes that there is a problem. So that is basically what we are saying. Okay, so other things, we'll just run through this quickly. We are almost done. Other things are about giving a viable borrower a second chance, isn't it? So, and that means restructuring. Okay. So, the early warning signs can be detected, and we might do a good job detecting them early. But what do we do? What are our options? Okay. So, what are the options at the bank disposal? Well, one of them can be the issue of rescheduling, isn't it? So, for rescheduling, it's quite common, because then what would happen is, in most cases we might actually extend the tenure, right? So maybe the tenure, it was 3 years, now we take it to 5 years. Okay, so that the monthly repayment can become smaller, at least to something that can be is manageable, isn't it? Okay, so that's what we do. Also, the bank, um, yeah, so the bank gets paid more slowly, obviously, but at least it gets paid. Other things would be the repayment holiday. Okay, so again, it is also useful, especially when a borrower is facing, a specific or a temporal shock, right? At the moment, a lot of things do happen. There is a scenario where one of the borrowers that we dealt with at one of the banks, had their factory on fire, right? So meaning that their production actually came to a halt for about 2 months, actually. So now, eh, that became a problem, and so the resolve for us was, okay, why don't we suspend principal payments, okay, at least for 90 days, right? And then the worst is the interest would still accrue. Okay, and then when the factory restarts, then the repayments resume. So those are the things that can happen. Okay, yeah. Okay, there is also things to do with uh, what else can we look at? Debt equity swaps. Okay, debt equity swaps. Okay, so you can actually decide to convert part of the debt into a shareholding in the borrower's business. That is also something that is that yeah, I know it sounds dramatic, but I mean, occasionally that is the right tool to use, especially for large corporations. You can do that. So the bank would convert some of the loan exposure into shareholding. Okay, so obviously the bank balance, I mean the loan balance decreases, and then it will reduce. But at least the bank gains in terms of equity stock, isn't it? Okay, and it is part of the ownership of that business. Okay, so in short, what is the key principle underlying restructuring? We need to know that it must not only be offered to viable businesses. Sorry, it must only, my apologies, it must only, okay, be offered to viable businesses. Okay, so restructuring an inviable, an unviable business will just delay the inevitable, and it will even increase your exposure as a bank. So those are the things really. Unless it is viable, can we do that? Okay. So other things, um, yeah, you can have some time to look at this. I think we'll be able to run through some of these calculations physically when we meet, but these are just some calculations around the ratios. So there are usually three ratios that are of interest. Yeah, so yes, so usually we look at the NPL ratio. So the NPL ratio, yeah, so like we are looking at, say, like what percentage of the loan book is not performing, isn't it? Okay, and if it is above 10%, then it is a serious issue. So Bank of Zambia would do a lot of monitoring here so that they see um, where problems are and where they might have to intervene. Okay, so that is that. Others are the provision coverage ratio, and then also the cost risk ratio. We'll look at these, I think, in the next section due to time. Okay, and then the regulatory framework as well. What is guiding what we have just discussed today, and those are the ones. So you can also have a look at that. Remember the notes that I've shared. You can be able to look at those things there. So I think for now we end it here. I will be able to see you in the next session where we do a bit of some calculations around the ratios and then just finalize on this section. Okay, so for now, thank you, and we'll see you in the next session.